The first item of business, if we can proceed, the first item of business, of course, is approval of the minutes of the October the 28th meeting. Well, yeah, let's do October 28th. That's first on the agenda. We'll go to item B, which is October the 12th. Everyone's had an opportunity to look at the minutes. Are there any modifications required? If not, can I have a motion to approve?
So moved.
Second.
Mike Bruno, second. Jim moved. Okay, all those in favor of approval of the October 28th minutes, please signify by raising your hand.
Aye.
Aye.
Aye, in case of Mike Bruno, of course. All right, any opposed? Okay, that's carried. Also, we have to approve the minutes of the special retirement board meeting of October the 12th. Those minutes are appropriately brief, if not opaque. I can have a motion to approve.
So moved, Mike.
Mike moved, Jim Canane second. All those in favor?
Aye.
Hands
Aye.
and voice. Okay, fine. All right, let's go to request for benefits. We have under retirement benefits, we have 13 civilian requests and 1 police request. First, the civilian requests, of which again, there are 13. Are there any questions about any of the requests? May I have a motion to approve the civilian request? Jim? Jim moves that we approve. May I have a second?
Mike.
Brian beat you to the punch, Mike, this time.
Brian, oh, real nice, Brian.
Brian wants to, he wants to be recognized in the minutes of this meeting. All righty, fine. All those in favor of approval of the civilian request, please say aye.
Aye.
Any opposed? Okay, going on, we have 1 police request for retirement benefits. I wonder when that dam is going to break, but we have 1 request for a police. I have a motion to approve.
So moved.
Jim Canane moves.
I'd be happy to second, but I want to give Mike the opportunity.
Oh, you hurt my feelings.
We'll give it to Mike this time. We'll give it to
Okay.
Mike. Try to keep
Thank you.
things even. Try to keep things at peace among the board members. All righty. Mike Bruno, second. May I have all those in favor, please say, signify by saying aye.
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 Aye. Any opposed? Okay, unfortunately, the applicant for death benefits, there's 3 civilian requests, 0 police requests. May I have a motion to approve the 3 civilian requests?
Mike, so moved.
And any opposed to that? May I have a second? I'm sorry.
I'll do the second.
Brian. Okay, seconded. May I have a motion, excuse me, may I have the vote, all those in favor of approval
Aye.
of the civilian
Aye.
requests?
Aye.
Aye. Any, any opposed? I don't know why you could, but nonetheless, I thought I'd ask the question. I would like now to turn the meeting over to Asset Consulting Group. Jason and Phineas, are you on?
We are here. Can you hear us?
Could you first start at the review of our performance versus peers through the 3rd quarter, and then go into the performance report for the month of October, and then the deep dive into managers. And while you're focusing on the individual managers, you can bring up the response that William Blair sent to us to the questions that they received.
Sounds good. Can someone give us the ability to share our screen?
Matt, are you still on?
Yes, ma'am.
Can you let them share?
Yes, I'm sorry. What's the name of the person who needs to share?
Phineas Troy.
Got it. Okay, you're a presenter. You should be able to share your screen now.
Thank you. Yeah. Okay, so we'll start with the
Excuse me.
report as soon as we get this open. Okay.
Yeah, but I would like to start with the third, okay, we've got third quarter.
This is the third quarter, and I'll just zoom through this. So just
The third quarter, peer review, please.
yep, we'll get right to it. So you'll see on this page 19 the performance of the portfolio and the peer group analysis. On the right side of the page, year to date, which is the first 9 months of the year, portfolio is up 10.15%, which ranks in the 15th percentile, meaning you're outperforming 85% of peers. In the 1 year period, the year over year ending September 30th, portfolio is up 24%, ranks in the 7th percentile. So meaning you're outperforming 93% of peers. And we're comparing you to a peer group of other public pension funds between 100 million and a billion. And over that 1 year period, there's 152 observations in the peer group over that period. Overall time periods, 3, 5, and 10 years, very strong absolute returns, double digits, north of 11% on a 3 and 5 year basis, close to 11% over the trailing 10 years, ahead of the broad policy index, which just is a static, passive blend of global equities and investment grade bonds, and the strategic policy index, which would be reflective of a passive implementation that's more consistent with your the sub strategies in your asset allocation, including non-US, small cap, real estate as well. If we look on the next page, just in terms of from a risk return standpoint, what we would expect to see is the portfolio risk being lower than that broad policy index, which is just stocks and bonds. The diversification is providing risk mitigation, a little bit higher than the strategic policy index. But the standard deviation, if we look at that in the upper right over the last 10 years of your portfolio at 9.2 relative to the broad policy index of 10.5. So getting higher return with lower risk than that broad stock and bond blend, a little bit higher return than the strategic policy index with a little bit more volatility, but the Sharpe ratio is higher. Again, just to focus on peer group rankings again for a moment. This page just reflective of what I just touched on. You see at the bottom, though, the dispersion between the quartile. So if we look at the 10-year on the far right, you'll notice really strong returns across the board. So even bottom quartile funds were up 8.9% over the trailing 10 years. The top quartile public pension funds between 100 million and a billion up 10.5%, and you're above that at 10.74. So really, where public pension funds of your size came in over the last 10 years was somewhere between 8.9 and 10.6, and you're above that. And within that 10-year period, there's 119 observations over that 10-year period. 3 and 5 years, as I mentioned, just very strong absolute returns, very strong relative returns, and most importantly, relative to your funding benchmark, you've done very well. Page that I skipped over, and I just always like to mention it on a 1 year basis. September through October of 2020 through September of 2021, the portfolio grew by $183 million on a dollar basis. Net cash flows, which is your contributions in less benefit payments and expenses of 20.65 million. So you ended that 1 year period at 927.9 million, almost 928 million. October was another good month. The fund was up in October little over 3%. It finished the month at 955 million. So almost a $200 million gain in the last 13 months alone. If we go back a little further, it's even more dramatic. With that, we thought we would, we'll spend a little bit of time on individual management of the ASAP. And then, on that. So we'll go to the October report briefly, just to look at asset classes, and then we've actually put together some supplemental material, which we'll pull up on our screen, looking at more qualitative characteristics of your asset class composites and individual managers versus their benchmarks, to talk a little bit about some of the questions that came up last month with respect to, are the managers doing what they're supposed to do? How do they complement one another? We'll walk through that. But just in the October report, looking at from a composite standpoint, the overall fund 1 year through the end of October, as I mentioned, the asset value up about 27 million in the month of October, 955.9 million. The 1 year return now 29.2 million, or 29.2%, versus your strategic policy index at 24.8 and the broad policy index at 28%. So
Pretty soon we'll be talking about big money.
Yeah, exactly. And pretty significant excess return. And it's really coming from across the board in your portfolio. If we look at the major asset class composites, and we'll break, U.S. equity, which is a blend of your large and small cap, up 47% on the year versus the Russell 3000 broad U.S. equity index, up 43.9. Your large cap overall, slightly behind on a 1 year basis, about 84 basis points. Although longer term, we've actually seen this change, because when we looked at this a while back, the longer term was a little bit behind, but now your long term since inception for your large cap composite, going back to 2007, is 29 basis points net of fees ahead of the benchmarking. But we have done some things to bring down the active exposure there to try not to take as much benchmark risk in a much more efficient asset class. In small cap, here we're implementing with two managers, Ernest and Granite, and we'll show you in a little bit how they complement one another. But the combination of those two, up 59.4% on a trailing 1 year, versus the benchmark Russell 2000 up 50.8, adding about 8.6% relative performance. Non-U.S. equity, this is a little larger roll-up of sub strategies, includes the developed managers of WCM and Sanderson on the developed growth and value, and then your small cap managers of Mondrian and William Blair, as well as Acadian on the EM side. This composite up 33.7% relative to the broad non-U.S. ACWI ex-U.S. index, which is up 29.6%. So adding about 4%, 400 basis points. Fixed income, it's while we're talking less than a 1% return in fixed income, still on a relative basis, relative to what fixed income markets have given us, which has been negative returns over the last year as rates have gone up. More interest rate sensitive strategies, it's more of a headwind. The more duration you have in your portfolio, the more sensitivity duration. Your active managers in IRM and Western have been able to navigate this pretty well to produce some positive return on a 1 year basis. And we look out 3, 5, and 10 years, while still much more muted, much lower volatility, risk reduction from this portion of the portfolio, but actually adding value relative to the benchmark. And then finally, the real asset portfolio, this is a roll up of your 3 real estate managers, Reef, Heitman, and Prissa 3. the more person three being the more value add strategy. The roll up of these three strategies up almost 15.7% on a 1 year basis versus the benchmark up 13.6. So really, across the board.
Jason Milt here, looking ahead, when do you think we will have the full calendar year results for the real assets component so that we will be able to calculate what our true calendar year performance is
Well, the
or
quarter
was?
September is through September. For 12/31, we should have 12/31 updated values for all the real estate by mid-February. So when we do the quarter report for fourth quarter, February, we'll have updated real estate numbers.
Okay, so in January, just so everybody's clear, in January, we're going to get an interim calendar year 2021 report, which would not have up-to-date real asset values. And in February, we will have the full report with completed real asset values, correct?
Yeah, I'd say maybe we might have them by the time we do the January report because you're meeting so late. So I don't want to say we won't. But
Yeah, look, I'd be surprised if you did.
right.
So I'm simply saying I think it's going to be, it may very well be February before we can truly report our calendar year 2021 results.
Yeah.
And I think that's important for the county executive offices to know. But it hopefully we'll have good numbers even on interim basis and somewhat better numbers on a calendar year basis. On a full calendar year basis.
So far, now just looking at year-to-date numbers for the total calendar year-to-date up 13.7. You know, today's the last day of November. Prior to today, the S&P was actually positive month to date, although we gave up 190 basis points today, so it went slightly negative. Small cap is down on the month. International is down on the month, but still year-to-date, even with today, S&P is probably up 24%. Small caps up about 13%. International developed is up probably around 6.5%, and emerging markets are down slightly. So still pretty strong performance despite kind of the sell-off we're seeing the last few days. So with that, I'm going to hand it over to Finney, and he'll talk a little bit more about individual managers and some analysis we've put together more qualitatively on how the managers fit together and complement one another.
Yeah, perfect. So actually with that, I'm going to take this down and pull up another deck. Just give me a second here. But as Jason said, we've put some supplemental material together around, a lot of questions have been raised in some of this last month and in previous meetings around benchmarks, and are they a good fit with our current managers, and vice versa? Our current managers are a good fit with the benchmarks that we're modeling. And then also in particular, as Jason mentioned, thinking about not just each individual manager in isolation, but how they all fit together in the overall pie. And so what you'll see is, as I pull this up, is we've put together a little bit just of a comparison. And just so you all know, this is data that we share with you every quarter. That's in our quarterly book on individual managers, as they each have their own individual page. So it's not necessarily new data, but we thought it would be helpful to put this data together in more of a kind of user-friendly format, so you can see actually managers kind of next to each other and how they form different composites. So ultimately what we've done here is we've broken down both individual managers as well as some of our composites on various things relative. You can see here size, EPS growth, profitability, price to book, which is a valuation component, dividend yield, et cetera. Really to see, like we said, first of all, how the individual managers work together, how we're actually in each individual manager gives us different exposure in our portfolio. But then also, as it relates to benchmarks and the questions that come up, but our managers and our benchmarks really reflective of the opportunity set. that our managers are investing in, because certainly that's very important to us. As we model our expectations, we want to make sure our managers are providing the exposures we're looking for. That said, we should note for our active managers, which we use mostly in our portfolio besides Rumline, for them to outperform their benchmarks, especially after active manager fees, they do need to look different from their benchmarks. And so, we want them to be similar, but not necessarily right on top of each other from an exposure standpoint. And so what you can see here, starting off with our large cap portfolio, what we've put together on this page is the three different benchmarks we use as we look at our large cap portfolio. In green, you can see the Russell 1000 value. Just going kind of left to right here, that our large cap composite. So that's our three managers together. So as they work together in aggregate, how they shape out. The Russell 1000, which as Jason just went through, that is our benchmark for our entire large cap portfolio. And then the Russell 1000 growth there in yellow. And I think, a couple things that hopefully I think stand out on this page that we want to highlight is first just how different the two stylistic benchmarks are on either side. The value and the growth benchmark, you can see in all the different categories, certainly quite different. And then not surprisingly, the broad core benchmark, the Russell 1000, right in the middle there. And then you can see that dark blue line, our large cap composite, kind of really right there, very similar with the broad Russell 1000 value. Again, we think this is very relevant as we model and try to capture, kind of model out our large cap performance. We want it to be representative of the broad opportunity set. And again, it's not just individual managers, but how they all work together. And you can see broadly, we're very similar to the broad opportunity set. And then how we get to that, to kind of roll the three up, is what you see here on the next page. And so kind of we put together here, again, it's the same criteria from a size standpoint, a profitability of the underlying companies they invest in, the valuation and the dividend yield. And you can see on the bookends, we have the same thing, the Russell 1000 value and the Russell 1000 growth. And then what we've added are three individual managers. So there in purple is Aristotle, our large cap value manager, right next to the Russell 1000 value. Rumline, which again is our one passive exposure. So it kind of closely matches the benchmark. So we just kind of put in there. And then Jennison in gray, closer to the Russell 1000 growth. And so again, certainly obviously the benchmarks are very different, but you can see in particular our two active managers, Aristotle and Jennison, are providing very different exposures for our portfolio. They are much different than each other. They are, though, much more similar to the benchmarks that they're trying to, I'll say represent, but compete against and add value on top of. Again, they're active managers, so they're not looking to exactly match each benchmark. They want to be a little bit different, so based on kind of where they see the opportunities, so they can add value, again, ideally ahead of their fees. You can see they're much more in line with their specific areas, value and growth. And again, also want to point this out, this is a snapshot in time. This is as of September 30th, how the exposures look. And certainly benchmarks will move around a little bit, but we expect our managers to move around even more, again, as they are actively evaluating where the opportunity is. But again, we think this is a good visual, not only of a couple things. One, how our individual managers are providing us different exposures. How two, they're much more similar to their specific spaces that they're trying to invest in, but then bringing it back to the previous page, how they all kind of roll together. They're broadly giving us that exposure we want from the large cap perspective. We've done this kind of across really our portfolio. And so we want to show this just on the various different active equity components. And so what we have here is our small cap portfolio. And so that's what's here in red is, again, we're looking at the same characteristics, but our small cap portfolio is our combination of Earnest and Granite. And you can see we've compared both to the Russell 2500 and the Russell 2000. And so I want to make this point here that our benchmark for our small cap portfolio, those two managers, is the Russell 2000. And that's because as we do our annual asset allocation review, we model this versus the Russell 2000. That said, a couple of years ago, we added Earnest to the portfolio, and Earnest has more of or includes some mid-cap exposure in their portfolio. So they're more of a SMID manager. We thought that was positive to add to the portfolio. And so as you'll see on the next page, we compare Earnest versus a SMID benchmark But when you bring them together, we still think it's relevant to compare it to our original Russell 2000. Now, as you look kind of across, particularly the three characteristics on the right, you can see the two benchmarks, the 2500, the 2000, are very similar. Really, the one difference comes from a market cap standpoint on the left. You can see, as obviously it makes sense, the Russell 2500 is a little bit bigger in market cap space than the 2000. And so you can see there our portfolio then fits right between the two. So we got a little bit, a little bit larger than the SMID cap portfolio, or excuse me, than the Russell 2000, but smaller than the SMID cap. And just to kind of, again, compare how the individual managers break down on the following page. Again, on the left, we compare Earnest to its specific benchmark, the Russell 2500 value, and then Granite, which is more of a core manager, small cap, really purely to the Russell 2000. And so kind of, again, very similar. Both managers are certainly closer in line with their respective benchmarks than the other one, but they both still take active positioning. You can see here in particular, both think it's very attractive right now to focus on profitability and EPS growth in their portfolio. A lot of this has really had them to add value versus our portfolio. And then again, obviously you can see on the
Kenny?
left.
Kenny, it's Mike. How you doing?
Good. How are you?
Yeah, I'm fine, thanks. So just a few questions on the small cap portion of the portfolio.
Yeah.
So now we're focusing on the US side. I know we had those managers in last time that were on the international side. What do you have any idea? I'm sure you do, or you can find out what the median market cap of those two managers are, Earnest and Granite. In other words, how small are they?
The median market cap, yes, and that is, Jason pulling up, that is in our quarterly book. And instead of me swapping screens real quick to look at it.
Yeah, I'm sure you got it somewhere. I just didn't.
So the median market cap for Earnest is 5.8 billion, and the median market cap for Granite is 2.7 billion.
Okay.
So much smaller. I think the other thing that you have to look at is the breakdown of market cap, the allocation, because the median is just telling us the one particular stock that's in the middle, but looking at the breakdown or distribution across market cap. So Earnest, we know going in that they're going to be SMID, they're going to move up into mid, and they will also let winners run a little bit, and particularly in this frothy market, but they're not going in and buying names that are at $9.8 billion market cap. Those are names that have run a little bit and that they're going to be trimming at some point.
So, okay, I get that. So on Granite, don't they have just a small cap index instead of using the Russell 2000 or 25? Don't they have just a small cap index you can benchmark against Granite, for instance?
That's Russell 2000 is the small cap benchmark.
Really? There's not other benchmarks for small cap? Because Russell is kind of big for small caps. What's the median market cap on Russell 2? Do you have that?
I think that's in there. So that's the most, I say, prominent, if you will, Mike, that we see and we use most. Well, I should say also, and while Jason's looking this up, what managers tend to compare themselves to, because one thing, I haven't mentioned yet, but as we look at the individual managers, so all the benchmarks that we use are the manager's stated benchmarks. And why that's important is, that's who they view their full opportunity set as. That's who they know that they're being compared against. And so certainly they want to outperform, but they also want to, if they, not only underperform much, but also just differ too much from underlying holdings, certainly they can, have business risk on their side.
So the median market cap of the Russell 2000 is 1.1 and Granite is 2.7. The weighted average market cap of the Russell 2000, as we show here, is 3.28 or 3.3 billion, and they're 3.5 billion.
Okay. Okay. Very good. Thank you.
No problem. And I think I'm going to just hop over a few pages ahead real quick because to this point, especially as it relates to size, so again, what we have here, this is just weighted average market cap. So just on size, but it looks at, so the blue, and you all can read it, but if it's too small, our large cap in blue and then our small cap there in red. So again, yes, while we added Ernest and it goes a little bit, certainly above the Russell 2000 into the mid-cap space, it's very much playing in different fields and giving us different exposures than we have elsewhere in the portfolio. And very similar, same, story really on the international side. And that's that teal boxes are developed really kind of all cap, large cap. So that's Sanderson and WCM, playing in a much larger space from a market cap standpoint. And then the managers we heard from last month, William Blair and Mondrian, again, similar stories they talk about. Sometimes they'll let their winners run, but they're still, very much on the smaller side, adding a different exposure to our portfolio than we're currently receiving.
So the other thing we look at is sector allocations, and you really see that on the US side, where the exposures for your value and growth managers are very different from a sector standpoint. Your growth managers in large cap is Jennison, your value manager Aristotle. And we talk a lot about Aristotle's more relative value, as is Ernest. They're not a deep value manager. They're not a really contrarian manager, but you see their exposures do complement one another. Whereas Jennison is at 42% technology, Aristotle's at 20%. Technology is a growth-oriented sector. Financials more value-oriented sector, and you see Aristotle overweight financials and Jennison at about 2%. And then also kind of materials more value-oriented in large cap as well. And it's similar on small cap.
Excuse me, could you go back for a moment, please, Jason? Jennison's exposure to the technology sector, 42%. Do you know how they classify Tesla? Do they classify that as technology or industrial?
I'm not sure. Well, I don't think Tesla is a technology.
Because as you know, Tesla has a very prominent position in the Jennison portfolio. And I was just wondering, was that what was skewing that number way up?
Well, it's skewed relative to the core benchmark.
Yeah.
The growth benchmark, which we're not sure, they're actually underweight technology relative to the growth benchmark. So
Matter of information. I didn't have an objection to it. I just wanted to know how they were classified, or how you're classifying, or how they classify themselves. All right.
So what we're trying to show here is really how the managers differ from the core asset class benchmark and how they complement one another. But it's important, value and growth benchmarks are very different. So the growth Russell 1000 growth to technology exposure is 44%. So they're slightly underweight technology relative to their benchmark, their style benchmark.
Okay.
So we do the same thing in small cap, and it's pretty similar. It starts to get a little bit skewed in small cap, as typically these managers are looking for companies that are growing at a greater rate. You tend to see a little bit more in industrials in both of your managers here. But if we look at Ernest, which we would call more relative value, you'll see those exposures to, again, materials, a little bit in utilities, and then real estate, which is public REITs. They have a pretty significant exposure there relative to the benchmark, about 11%, whereas the core benchmark is 2.2%. The value benchmark, a little bit more. The value benchmark for real estate is 12.2. So they're a little bit under the value benchmark, but you're getting that exposure there that's more value oriented.
And then, yeah, obviously, similar, international, as we've touched on, again, with Sanderson, more on the value side, WCM, who, again, we, tends to lean more course, and why these two seem to pair so well together, have paired so well together in our portfolio. You can continue to see that, and I think it particularly, hits home with WCM, certainly kind of some of their large allocations in the traditional growth space currently. And last thing, and again, we had both these managers in last month. Mondrian and William Blair, who definitely take, different approaches as they look at international small cap in the different spaces. But again, you can see that they tend to pair quite a bit very well together. So again, I think that the theme of this is, yes, every individual manager matters. We want them to compete well and perform well in their space. But it also certainly matters how they roll up to their specific composites, which then obviously rolls up to our total portfolio and really drives our overall performance.
So I guess a couple things from an asset allocation standpoint with respect to your strategic policy index, we believe the benchmarks we're using in that are appropriate and representative of the asset classes that we're implementing. At the implementation level for each manager, we spend time with the manager up front, making sure that the benchmark we're using is their stated benchmark and that it's agreed upon with them up front when you contract with them. If there is a inherent style bias, we will utilize a secondary benchmark just for practical purposes to be able to see what may or may not be working better or worse in a particular period. But we're comfortable that the stated benchmarks for each manager are the appropriate benchmarks. And we're comfortable based on, we didn't just do this now, we do this on an ongoing basis, making sure that the managers that are being paired together are complementary of one another, take a different approach and are getting different exposures to provide greater diversification across the overall portfolio at the broad asset class and within asset classes.
Yeah, I mean, just to echo that, as you guys even kind of flip through the rest of the quarterly book, like I said, all this data is in there. We think it helps to look at it this way, but also in there is the performance goal system that Jason was just talking about of each individual manager and how it relates to their specific benchmark and how we expect them to perform relative. So it's good. I mean, the questions that we've received for the last couple of months, we've talked about, and we hit with both Mondrian and William Blair, last month. We continue to appreciate it and think it's good, but thought worthwhile, again, just kind of making this a little bit more visually easy to follow, just to put some of this comparison together for this quarter, given some of the recent questions and conversations.
And I don't know that it's going to be like this every month, every quarter, but it has been for some time. That every active manager that you have, with the exception of one real estate manager, is outperforming their stated benchmark since inception. So Heitman is about 25 basis points behind since inception. On a one-year basis, they're about 180 ahead. But every active manager is ahead since inception. So they're doing well, and we don't have any particular concerns about manager drift or inappropriate benchmarks at this time.
So what about, this is Mike again, Mondrian, their returns? You have that in front of you, it's page 3 on your deck.
Since inception, they've outperformed net of fees by 20 basis points. The more recent time period has been a bit challenging, and they talked about that last month. It's been more of a quality bias. While they are value oriented, they use a dividend discount model. They tend to own higher quality names, and that has underperformed. Low quality in small cap, not just in the U.S., but outside the U.S., has done very well, particularly over the first several months of this year. And it's been hard to keep up for some active managers. And so, yeah, they're up 31.5% on a trailing one-year basis, where the benchmark is up 37.
So I see their inception started July of 2009. So that's for 12 years they've outperformed. I see that.
Yep. And it's really been more recent, like I said, Mike, with this lower quality rally that they've underperformed. And frankly, we would expect them to underperform in this type of a environment when low quality is outperforming.
Okay. I know the MSCI EFI, the MSCI ACWI, Is that all cap or what's it?
It's
AC?
all country.
All country.
So that includes emerging markets.
Okay. All cap, is it all cap world index, I guess?
It's all country.
I mean, all country, I'm sorry, yeah.
Ex-US.
I got
So
you.
that's for WCM, that excludes the US, because WCM will have opportunistic exposure to emerging markets. It could have 20 to 25%, and that benchmark actually, the ACWI ex-US is about 30% emerging markets now. Whereas Sanderson, we're using the EFI value because they're not really going into emerging markets, nor is Mondrian going into emerging markets. The world there, that includes Canada, but the ex-US does not include, the ex-US small cap does not include emerging markets because they're not investing in emerging markets, whereas William Blair, on the more growth oriented, we're using the ACWI ex-US small cap, which is the all country world index small cap, ex-US small cap. And so that includes emerging markets, and they have exposure, which they talked about last month. Their exposure to emerging markets is about 20% for William Blair, whereas Mondrian they have a little bit, about 5%.
Okay, so when we show kind of how our asset classes are broken down, do we include in emerging markets that 20 or 30% that's
Yeah, so
in-
what we're using for the composite for the non-US equity, that international equity policy index, that includes emerging markets as well.
Okay. Very good.
So we didn't send this around. We thought, and a lot of this, in more details in the book, like Finney said, we thought it was helpful to put them side by side. They're not side by side in the book. Hopefully this is helpful. But I think it's important to note that we think things are going well, and the managers they complement each other well.
Do you feel that way about the real estate portfolio as well? Recognizing it isn't fully funded yet.
Yeah, we do. I think at a 15% target, these managers are doing a little bit different things. We didn't go into great detail on that here, but we can look at that at another meeting, Mel. But we do think they're, PRISA 3, more value add, and they're doing a few different things. Not getting from the pure core managers in Heitman and Reef. So yes, we do.
Yeah,
Haven't we heard from all three within the last 12 months or not?
I don't know.
Or do you
in the last
recall?
last 24 months, but
yeah, I don't recall
Right.
you having them in the meeting, and that would have been the last 12.
Yeah, like in 2020, we probably didn't care. There was so many other things to focus on. Okay. Continue if there is anything to
Well,
continue.
that's all we had, unless there's any questions. You want to pull up that funding sheet. The last thing, if you want it, we also distributed the funding update, which is it just regurgitates some of the other information on the returns. But I also want to just remind everyone that the funding number that we're putting in here is purely an estimate based on market value. It's not the actual funded status, but it's based on actual movement of asset values and our assumptions based on the last actuarial valuation. But it shouldn't be used as gospel for your actuarial valuation. But obviously, with assets going up, things look good right now, but it won't reflect the same numbers that Buck is using.
Jason, let me bring up one more thing before we move away from you guys. I just this morning watched a presentation by DFA on a new fund that they have. It's literally just coming out. I don't even know if it trades yet. It's an emerging market ex-China fund, which appeals to me because I wouldn't give China I won't go there, but
Yeah, understand.
huh?
Understand. Yeah, go ahead.
No, I just say it's, I don't know if it's something worth at least take, I didn't talk to anybody, but I don't know if it's anything worth looking into. It's it's a core emerging market ex-China fund. It was an interesting presentation. Anyway, might be something to,
Do you have a copy of that presentation, Michael?
I'm going to see if I can get one. They did mention having slides available. So my only contacts are all retired, but there is a guy's name they gave me. So I'm going to call him, and if I can get it out to everybody, I will.
Okay, very good. I'd like to see it as well. Thank you.
Good.
Mike, I would just say on that first, so a lot of conversations, obviously, certainly around China from an investment standpoint, and people have talked about ex-China, and certainly there are some for political reasons people don't want to trust China, and that's certainly understandable. But more often than not, why we see firms coming up with ex-China products is because there's also more people coming out with China-only products. So certainly just because of how sophisticated, or I should say how sophisticated, how expansive the market has gotten, many more opportunities, that actually a lot of investors are doing China-only investments and then pair that with an ex-China opportunity. And so that's actually kind of more so where I've seen people have interest in an ex-China fund. Certainly understand the political aspects of it, but also just in terms of from a return standpoint. I mean, certainly China continues to lead a lot of be a growth driver, significant area, one of the largest growing economies in the world. And so most investors' standpoint, it's hard to not have exposure to them from a return standpoint, unless you have, like I said, some have started to add a dedicated China-only product or mandate.
China represents 40% of the emerging markets index.
It's such a big component of the passive benchmark.
30%. I think it's like 30% according to their thing today, but it's a big nut, no question about it. But I look on it from a totally different perspective. I look at it from a moral standpoint. Why would I want to invest any money in a country that wants to bury us? And yet we keep, whistling past the graveyard like there's nothing happening. And
No, we appreciate that. I think it is difficult for public pension funds to take that position because there could be, it's a slippery slope. What is what's the next issue? So typically in the public pension fund space, unless there's some direct mandate, and we've seen states and municipalities issue legislation that might restrict investment. Certainly, we've seen it with Sudan, Iran, North Korea, but it's not the case with China today.
Yeah, I understand. I look at it differently, but I hear what you're saying.
Milt, I just wanted to check. I had a commitment at 4:30. Is there anything else you need me for? From a
Nothing else for
perspective?
nothing else for a vote. I would like for Sue to tell us, Sue, since we're on the talk about the actuarial situation. And should we plan on having our new actuaries meet with us in December or in January? Because historically it's been January.
I think that January would be best, and it'll be Foster and Foster. That's who we changed from Buff to Foster and Foster. So I'll talk to them, and we'll plan on them meeting with the board in January.
And historically, Buff would take us through a series of, and a relatively exhaustive series of questions that would allow us to double check our assumptions that we are for various aspects going forward, so they can actually go ahead and do their study. So I presume Foster and Foster is going to will want to do the same thing.
Yes.
I hope they do. All righty. Brian, there's nothing else that you need to be here for. We're gonna wrap up very, very shortly, but there's nothing else you need to be here for.
Okay, sorry about that. And I'll follow up with you tomorrow in case there's anything I missed. I appreciate it.
Thank you.
Very good.
I'll do the second motions for you, Brian.
Thank you, Mike. I appreciate that.
Okay, Sue, is there anything else you want to bring to our attention at the moment? And we can open to visitors. However, you have to tell me, other than Marion, are there any visitors? But
There was something on the agenda, the retirement office staffing, and we're going to table that until the December meeting.
December meeting, as you and I discussed.
Yes, and so I think there are some other visitors. I don't know. Let's see. Dave Gokin is on the line. Joyce Gullif is on the line. And then there's a John Kevin somebody. I can't read his last name. So there's 3 visitors out there if they want to say something.
Well, before we do that, a couple of things. Number one, what is the status of the county's deliberation, so to speak, on the recommendation for a COLA?
The county executive added that into his 2022 budget that is sitting with the council right now. So I don't know anything other than that. We did put together some legislation. If the budget passes, then that legislation will have to change the retirement ordinance to include the COLA. So if they pass the budget, then that is part of it. I don't know where they stand. I read the paper like everybody else, and I think that they're having debates about the county budget that the county executive submitted. So nothing else on that.
Okay, very good. I don't think there's any other business. I would like to ask you before we go to visitors. The next meeting is scheduled for December the 30th. Thursday, December the 30th. Does that, for the benefit of the members of the board who are still on here, does that work for you?
Yeah, for me, that Mike, I could probably do it on the 31st. That's how exciting I am.
You have to do it with champagne in hand. Jim, is that okay? Is that okay with you?
It's not a great day for me, but if it works for everyone else, I can certainly figure it out.
Okay, and I presume it works for ACG? Okay, fine. All right, fine. We'll open the meeting up for questions from visitors. If there are any, please alert us. If you'd like to raise a question.
Hey, Mel, it's Jerry. Can you hear me?
Jerry, yes, certainly. Hi.
Hi. So I was able to make it on for the meeting, just so you know. I don't know if the visitors will be able to talk. Can they unmute themselves? Do you know?
I do not know, Jerry, but we haven't asked. I'm not sure we have any questions from visitors because no one raised their hand immediately, but let's see.
Looks to be like David is messaging that he would like to make some comments. Should I pull him in as a presenter?
As a presenter, yes.
As a panelist.
Well, whatever is required for us to hear him.
All right, he's in.
Okay. I just wasn't aware how to get on to talk last time, so I just wanted to make sure how to do it this time. And I guess if I'm on in the category that I'm in, then I've got to do a chat and say I would like to make a comment so I can be unmuted, because I can't unmute myself. And you say, last time you say, well, I don't know if you couldn't see me or what. My name is up there, but I don't have any visual up there. But anyway, I don't really have anything to say. I just wanted to know at some point I will have something to say, and I want to know how to get on. That's all.
So you want to understand the process at this point. Okay. Very good. Are there any questions from any other visitors? If not, I guess we can bring our meeting to the point of adjournment. May I have a motion to adjourn?
Mike, so moved.
Jerry,
Second.
second.
And Jerry second. We want Jerry to be memorialized in the minutes. So
That's
we're going
right.
to give him the honor of second.
Thank you, Milt.
All righty. All those in favor say aye.
Aye.
Aye. Any opposed to adjourning the meeting until December the 30th? I see no opposition. That's
Thank you
wonderful.
all for being so responsive to this, to changing the meeting. I appreciate it.
We're good. Milt, I'll get you information on that ex-China thing, or I'll let you know if I can't, one way or another.
Yes, and if you can, Mike, just please send it directly to everybody on the board,
Okay,
plus Sue
right.
and Denise, so they'll have a copy.
Yeah, will do.
Okay,